So super excited for today. Thank you both for being a part of today. And real quick, just to give everyone a backstory of why we created this live Q&A every Thursday at 4 p.m. We created this due to the pandemic hitting, and we wanted to get back to our community. We wanted to get back by educating those in real estate. So today, without further ado, I'm going to introduce you to Michelle, who's been a part of our team. And she's been a certified appraiser for over 20 years. And she is going to take off today's live Q&A, interviewing one of my favorite lenders in the entire world, Jason Gill. So Michelle, take it away.
All right. Well, thanks everybody. Thanks for being here with us this Thursday. We are interviewing Jason Gill from the Gill Group, and he is the production manager, and he's been doing mortgages for about 20 years now, and he is our preferred lender that we send most of our business to. So Jason, you're here. Thank you for being here again with us. You were one of the first people that we interviewed when we started doing this Q&A, so thanks for coming back a few months later. Let's talk about the market. I wanted to just kind of get into what the market's been doing for, as far as it's just being a wild ride this past year. It's been a wild ride on the sales side of real estate, and we know it's been a wild ride for you on the mortgage side. So now that we're basically approaching the fourth quarter of 2020, I just wanted to kind of check in with you, get your pulse, see how your business is doing, and just kind of get your take on what's happening.
Yeah, of course. Thanks for having me. It has been a wild ride, but obviously for all of our personal lives and professional too. And, it's just been nonstop all year, especially on the lending side. I know for a while there, it was a little slow in real estate just because people couldn't go into homes and we couldn't hold open houses there for a short period of time. But the lending side, it's just been nonstop really since the beginning of the year. I at the end of last year, at the end of 19, I remember the back half of the year, and I cannot remember the last time I had so many people tell me that they were going to buy in 2020. And obviously that was, in the back half of 19. And so we already expected a huge year. We came right out of the gates in January with a tremendous amount of applications, purchase applications. And I had other loan officers reaching out to me saying, are you getting the same type of volume? And of course, this was all still before COVID and before rates really, really dropped. So, obviously things changed on the real estate side and purchase loans for us when COVID hit, a few weeks after. But the refinance loan volume has just absolutely skyrocketed. So and then when you combine that with the fact that things did open back up that first time, and people they had this pent up demand with these low interest rates and low inventory, and people were able to get out again and look at properties, then it just went bonkers. Then it was the refinance volume and the purchase loans all at the same time. So it's been fun.
You've had some sleepless nights, I bet.
I started work a few times at 3 a.m. just to get started. Yeah.
Wow. Yeah. You're a workaholic by nature. That's why I love you.
Aren't we all? So, I know my own personal take on this market is from the sales side is that you really have to have a lot of patience, and, properties are falling out of escrow quite more frequently than I think we've seen in the past. And why do you think that is?
I think that, and I think this has been the case for a long time. But I ultimately think that one of the main reasons I think transactions are falling out is sometimes the lack of transparency between the buyer and the seller. I think that there are property issues that I'm not saying someone's hiding something. I'm simply saying they don't just come out of the gates and say, look, I know that my electrical box or panel needs to be replaced and it's $3,000, whatever. They wait until there's whatever, maybe 2 weeks into escrow or a week and a half into escrow, and you've got a first-time buyer. Maybe the buyer's agent is or isn't prepping the buyer on, hey, look, there's always going to be something on the home inspection. And I think a lot of this surprise, because there are more first-time buyers in the market than there have been in a long time. So I think just that going through the process and maybe not, having that information kind of not sprung on them, but just the shock of it, I think if there was more transparency in the beginning about those types of things, and a seller came out and said, look, this is what's going on with my property. I'm selling based on a price according to, what we feel needs to be done. Here's a copy of a home inspection. I think, you would see a lot more of the deal, less deals falling out.
Yeah, I agree with that. I just dealt with that on a property that had an asbestos issue that they knew about, and they waited until the last possible minute to disclose it. And it just threw my buyers for a loop. It was a big cleanup, and my buyers would have been okay with it out the gate, but coming to them right at the end of the transaction was just too much. So absolutely, the transparency and the repairs is huge. And I actually always tell people, just get an inspection before. As a seller.
Right.
Get a home inspection, fix the stupid stuff, fix some of the maintenance items so it doesn't look like your report is bleeding when it gets back over basic little cosmetic things that can be fixed quickly and cheaply. And, and be upfront about any major issues. So I totally agree with that. Now let's talk about appraisals though, because appraisals are not meeting these purchase prices. What we're seeing right now, especially in LA, and I know Orange County is the same because I grew up there and that's where I first started appraising 20 years ago. This feels very familiar. The market, the buyers are pushing prices up faster than the appraisals can meet that purchase price. So how are you guys dealing with that? Are you seeing appraisals not meeting purchase price right now? And how is your company advising your clients and your realtors and how to deal with that?
We did see this a few years ago, and we are seeing it a little bit again. I think I've gotten lucky, maybe just by chance, that I haven't had too many issues with it. I can tell you that the market where I've had the most issues has been in the Bay Area. But other than that, I haven't had too many issues. But the times that we know where even the agents are honest about it and saying, hey, look, we know there's going to be an issue. Typically, the agents I've had to deal with that on, I mean, they've done a pretty good job of saying, either having the appraisal contingency removed from the start and prepping the buyer and saying, hey, look, and obviously I take a part in that depending on how the borrower's financing is being positioned. If there's a large down payment, then it's a matter of explanation to the buyer saying, look, it's not going to impact your financing. This is just a loan to value ratio on paper. If you're okay with the fact that the appraisal might come in $20,000 under the purchase price that you agreed upon, but you're putting 50% down, the loan won't change. It's just a loan to value ratio number. But for our clients who are putting small down payments, obviously it can be detrimental to the outcome of the transaction. So it's a case by case. But the agents have done, I think, because they dealt with this a few years ago, done what I feel is a much better job in dealing with it than they, did the first time around when we saw it a few years ago. So,
Yeah, definitely. In terms of removing the appraisal contingency, I just think these buyers have to be aware of that going into it, that they may have to come out of pocket and meet that difference if they really want the house, because there's other backup offers and buyers ready to take it if they're not. So yeah, especially in LA with the inventory in some of these suburban markets, there's just not enough to go around for as many buyers as there are. Okay.
And I think go ahead.
No, go, please.
I was going to say, I just think it's a matter of, taking the time in advance to educate the borrower and explain to them, okay, look, these are the possible repercussions. Oftentimes the initial reaction will be that, okay, well, I'm just going to sit this out and see what happens. And it's like, okay, well, that's fine. And no one wants to push you, but you have to understand what's driving the market. It's low inventory and it's low interest rates. So if you think one or two of those, both or one is going to go away anytime soon, then hold off. But, they're not going to make any more land in Los Angeles unless you're talking about going, further out into the outlying counties of Riverside, San Bernardino, and interest rates. We'll probably talk about that, but we really don't expect interest rates to climb substantially anytime soon. So,
what's your percentage of refinances right now versus sales?
So right now, for me, it's high refi. It's probably 50-50, maybe even 55-45 refi high. That's really high for me.
Wow.
Yeah, that's really, really high for me. I would say on average, or let's say last year, rates were still great last year. So I was probably 65, 70 purchase and then 30 refi. The year before that, when rates really started climbing in 18, we were like 85, purchase, 90% purchase. So it really has to do with, we've done so many purchase transactions over the years, and we build this huge database. And then when the rates drop, obviously a lot of people take advantage of it to reduce the term on their mortgage or what have you. So that percentage tends to fluctuate based on the year. Like 2012, it was higher. This year it's higher. I mean, this year it's probably going to be as high as it's ever been just because of the rates. But yeah, but we're still doing a lot of purchases. It's just, with limited inventory, it's harder to do as many transactions too. So.
Yeah, definitely. With the inventory being so low, it's just not there. So in terms of, I know your area in Orange County, I mean, you're dealing with a higher income level just across the board compared to a lot of other areas throughout Southern California. So are you seeing people having difficulties qualifying right now based on effects of COVID?
Yeah.
Either income stability or just maybe they had to take a cut and pay and being able to qualify compared to pre-COVID income status?
Definitely. I mean, we've had so many different types of circumstances. We just had, I've, like, for example, I have a client right now that he wants to refinance. He's probably going to have to wait. He is at the end of his career, and he's just being very generous. He took a 50% pay cut so that the younger employees, he's in management, so the younger employees of the company could continue to have jobs. So because he can financially afford to do so. And, but unfortunately that's stopping him from refinancing one of his properties. So, and then we've had, some self-employed borrowers, it's been hit or miss. They've either thrived in this market. I have one right now that he happened to last year start, the year before, but really started thriving last year in the online food service. So of course that took off even more so during COVID. And so he's been, he's doing great. But then of course I've had, the restaurant owner who had to shut down, and they couldn't even do any takeout orders for a while. So, their profit and loss statement doesn't look very good. And, Fannie Mae and Freddie Mac did change the guidelines, hopefully temporarily, for self-employed borrowers in terms of the documentation we need to supply as opposed to pre-COVID. So that's hurt a lot of people because of what I just mentioned. So in terms of W-2 employees, again, maybe I've gotten lucky, but most of our W-2 employees, I've had very few that have been furloughed. And if they have, it's been for a short period of time. And luckily, as soon as they go back, as long as we get documentation that they're back to their full pay, then we're using their income right away again with the proper documentation. So, yeah, but it has been challenging for some.
Now I have a question regarding that, Jason. So when you say when they go back to being fully being paid, do you have to wait a few months, or can you do it right away?
Well, we can do it right away. So, but we need a verification of employment from the employer. We need them to specifically state that, okay, yes, here's the guaranteed hours again. Here is the, the confirmed pay rate that was, the same as previous, those types of things. And then typically, depending on how fast we need to close the transaction, we'll, if it's a refinance or a 30-day escrow on a purchase, we're going to get a pay stub anyway before we close. But I have had a couple where we needed to, ask the underwriter to post-close the upcoming pay stub to reconfirm, if you will, the verification of employment, and we're able to do it. So
that's huge, because so many lenders have to wait at least 3 months before they can, get a loan for their borrowers. So that's huge.
Yeah, we've been fortunate. Yeah.
So I want to talk about, since we're kind of on this topic here of COVID and the forbearance. I know there's quite a few lenders that, even though they are providing forbearance programs, some of them are having that amount of money, whether it's 3 months or 6 months, be due at the end, or giving them the option to refinance. So Donica and I have actually been noticing more pre-foreclosures hitting the record, hitting the public records. Just in the last month, we've noticed a huge uptick in pre-foreclosures. So I am personally attributing it. I'm thinking it has to do with these people that have had the 6-month forbearance coming due, and they have this big chunk, and maybe they're within that category of people where their income was affected and they can't qualify for a refinance, so they're stuck. So what are you seeing from your end?
Well, and yeah, Jason, if you can get into, because the one thing I love about you, sorry to cut you off, you're so super intelligent. And I really want your take on this from a professional point of view, but a personal point of view of where you see this going, if you don't mind.
Yeah, I mean, I think to be honest, some of this we're still going to have to wait and see how it plays out, right? Because, I've seen certain lenders be just right away, reaching out to borrowers and offering forbearance, and then allowing an extension of forbearance 2 and 3 times. And then I've seen other lenders that are with borrowers on adjustable rate mortgages that are saying no until they apply 2 or 3 times, when clearly the borrower is showing proof that they're on furlough, right? So I think some of this we're still going to see how it plays out. Um, I think that some of these pre-foreclosures that we're seeing may just be in this limbo stage where the borrowers maybe hit their limit on their forbearance, and so now they're still in the process of going through this workout with the lenders. And it's kind of similar to what we saw in 2010, 2011, maybe '09, where it was just a backlog of distressed inventory back then, and it was taking forever to get short sale approval. So same concept, right? That there's so many people in forbearance, and these servicing teams for these lenders, they're just absolutely overwhelmed with requests and things. So, but I think after the forbearance periods, whether they be 6 months or 3 months, there's just circumstances where they're reassessing and saying, okay, well, like you said, are you back to work? Are you gonna let you roll the deferral amount to the back end of the loan, or are you still not working and this is just never going to end? So I just don't think we're far enough into it, because if you think about it, forbearance probably started to be offered in April, because really, right? I mean, that's probably
Right.
the early. So let's just call it maybe May for most people. So June, July, August. I mean, September, you're only in month 4, and most people did at least forbearance for 3 months, and a lot of them are doing it for 6. So, I mean, being the beginning of October, we still really haven't seen the full repercussions of how this is going to play out.
What do you foresee the repercussions being on a professional point of view?
I think that lenders are going to rework the loans, and and I think they're going to roll and defer balances to the back end. I think a lot of people are going to take advantage of that. I think the challenge is going to be, like you said, when they go to refinance. From what I'm being told, is that the requirement is that any deferral amount be paid in full prior to being able to refinance. So that's what they consider being current. Is if I deferred $10,000, let's call that 3 payments,
Right.
to the back end, and then you come back later and say, okay, I want to refinance because I'm at 4.5%, then that 10,000 needs to be paid off. And the $10,000, you have to document where the money came from. So if you get a gift from a family member to pay it off, and I think the other thing that I had forgotten about, I didn't even think about it, is that, a lot of people have, when in their mortgage payment, they have their property taxes and insurance included in the payment.
Right.
So this is a big challenge this time of year. I mean, we're coming up on taxes being due in California if you're impounded. And the problem is that people, I think, forgot that, okay, not only are you going behind on your actual mortgage payment,
Right.
but you're no longer in paying a mortgage payment, not contributing to your impound account with your lender. So now the lender by law has to pay your taxes for you, but now you're also throwing your impound account into a shortage. So it's a kind of a double whammy, if you will, right? And so the lender's going to come back and say, well, you owe $10,000 in back payments, but now we're in a shortage in your impound account too. So it's going to be a lot to work that out, pay back the 10,000, and then reallocate those funds towards the impound account and the loan. So I think ultimately they'll work it out. I think, but there are going to be those cases in certain areas where, come on, let's face it, if you bought a home using an FHA mortgage and you did a down payment assistance program and you did a third behind that for your closing costs. There are markets where I've seen borrowers do, down payment assistance. So they didn't bring in the down payment, and then they took a third, a community, some type of assistance program locally to cover their closing costs. So they're literally in the transaction for no money or very little.
Right.
And now, they're in a situation where they're living in an area where there hasn't been any appreciation, right? This is probably not Southern California, but other markets. And they're in a job where, either their pay, if coming back at all, is maybe at not full capacity. you know, I mean, you could see some people after they play this out and defer their payments for as long as they can, between, you know, commissions to sell a property and back dues and, you know, these other things not being paid. I mean, you very well may see, I don't know that you'll see it to the degree that you saw it in '09,
Right.
but you very well could see some properties that people may just very well walk away.
Yeah, that makes sense. And it's interesting. You just had a little light bulb go off in my head being an investor saying, well, okay, that's certain number of people to go after as well to talk to. That's another conversation.
Yeah.
Well, from a you know, real estate sales side of the pictures, there's an opportunity there because a lot of these people aren't just in it for 100%. You know, there are other subset that do have equity, and they need to realize, listen, don't, at this point where the market is still climbing, going upwards in most areas, not everywhere, but definitely LA and Orange County, prices are still increasing. You know, explaining to the people that, you know, if you're in a position where you can't refinance, you can't come up with a $10,000 or $12,000, you know, check to pay off the forbearance, the lender at the forbearance, then, you know, it might be time to sell, cash out what equity you have in the property and move on, you know, to another situation, take that money out. So there is opportunity there in a different way. It's not going to be any kind of crash like it was obviously that we saw last time. Doesn't feel that way. But people are going to be hurt by COVID and just the economy in general, and, you know, unemployment. What's happened? People have not made their full paychecks for the last 6 months. That hurts people that live month to month and paycheck to paycheck. There's just no way around it. So we kind of talked about just your forecast for the general, you know, future. What is your general forecast? I mean, do you have, not that you have a crystal ball, but how long do you see interest rates holding at where they're at 2.5%? And how long do you see them holding at those low rates?
Well, I think we could in the short term, meaning, you know, let's just say if you were asking me to, you know, what I might think happen in the next few months, I think we might see a little bit of a climb in rates. I don't think anything substantial, and I think that would be due to some inflation that you know, we're probably going to see. But ultimately, I think that they will settle back down, and I think we'll see these low rates where we're at for quite a while. I mean, certainly, I think everyone should expect to see them through 2021. As to how far it goes beyond that, I think there's some factors there, right? Who gets elected? You know, do they change? You know, the Fed has definitely come out towards the end of this year, recently in the last 60, 90 days, and, you know, been pretty clear about, you know, their inflation targets and how they're going to look at that differently than they have in the past. And but, you know, all of that could change, because if someone else comes in and there's a new Fed chairman and they change on a dime their outlook, which, you know, may or may not happen, but I mean, those things could change. So, but ultimately, I think we'll see rates, you know, low for at least another year, and maybe even a little bit longer than that.
That's awesome. That's good.
Yeah.
Good to know.
Yeah.
So Jason, real quick, because I know we're getting close to the half-hour mark, and you've got so much going on your end. What areas do you cover? So it's not just California, correct?
That's correct. So, gosh, I'm licensed in California, Arizona, Nevada, Washington, Texas, Florida. That's it, I think. Yeah. And my company that I work for is licensed in every state except Georgia, but those are the ones that I'm licensed in.
That's awesome.
So I have a question just about the delays, because I know the mortgage companies, especially, I mean, title companies, escrow companies, appraisals are taking 2 weeks. Everybody's just backlogged. So how are you guys handling that? Are you able to get most of your stuff done in 30 days? Or are you pushing 40, 45?
I can talk about that, but I'll let Jason.
It's good to know.
Well, you know, it's funny because I'm seeing different things in different markets. I'm having a lot of trouble with title in Florida. They seem to be really, really backed up. I just did a refinance transaction. It ended up being 45 days, but only because we were waiting for title, which is kind of crazy. The appraisal issues, as far as delays that I've had, literally I have one 2-day right now that I was dealing with right before I got on this call, in the Bay Area though. And the major ones I've had have been in the Bay Area. For some reason, I don't know if it's coincidental or not. I think I've gotten, call it luck, I don't know what you want to call it, but I mean, I've closed quite a few purchase transactions in 15 days in the last 60, 90 days here in LA and Orange County. So a lot of those things, you know, we're able to close that quickly because we have the borrowers get fully underwritten and approved up front before they even write an offer on a property. You know, there's obviously some great relationships between escrow and title companies with the agents that are handling the transactions, so that helps.
Right.
You know, a lot of people are working very, very hard. Escrows are working extremely hard. This is the first time I can remember when I'm seeing escrow officers. You can tell they're coming in on Sundays and they start, you know, replying to emails or getting a head start for the week. You know, maybe because some of them are working from home, they're responding at 9 o'clock at night, 10 o'clock at night, 5 o'clock in the morning, which, you know, a lot of times for escrow companies was unheard of. But I think it's a combination of having access to, you know, working remote and just needing to keep up with the volume. So it's really been a joint effort on all parts with the agents and everyone.
So that brings up to I think our last question, right, Michelle?
Yes.
You touched on it, and I think it's so important, and that's why I think you are by far the best lender I've ever worked with in my entire real estate career, and I will always use you. Is you talked about being fully approved, and I think you honestly are the only lender in Southern California, or in California, in my opinion, that actually can do full approvals. So can you touch on what the difference is between being pre-approved and fully approved, and the other one where the pre-approval,
like a pre-qual and a pre-approval.
Pre-qual, thank you, pre-qual.
Yeah. So, of course. So, you know, I think there's people that have different versions and or definitions, and I think some of that is maybe because of what they're used to. I think other times you hear lenders call it certain things because of their legal constraints. But ultimately, at the end of the day, in layman's terms, you know, when I started back in 2000, the big thing was get pre-qualified, get your pre-qualification. And, you know, to me now in 2020, that means pre-qual to me means simply a verbal. I'm getting on the phone or I'm meeting with a client and I'm saying, okay, what's your credit score? Just tell me. How much debt do you have on a monthly basis? Let's go through that. Your car payment, your student loans, how much money do you make? You know, and how much money do you have to put down, bottom line? And based on those 5 triggers, whatever it is, this is a ballpark of what you qualify for. That to me is a pre-qual. That's the definition, and my definition of a pre-qual. Pre-approval is, this is where the problem starts, because the definition of pre-approval for lenders and agents can vary depending on who you're working with. And a pre-approval is the most widely used term in our industry now. And now it's common, hey, get your pre-approval. But the problem is you go to XYZ lender, and that means submitting an online form with your name, phone number, email address, and maybe if you're looking to purchase or refinance, what you think your credit score is, and the price, and maybe the estimated loan amount. And here's your boilerplate generated pre-approval letter in your email that comes 5 minutes later, which is really just meant to generate a lead so that someone from that company can call you and, you know, try to get you to use them for your mortgage. And then there's others that are, you know, doing what they're supposed to be doing and having the borrower fill out an application, running the credit, reviewing the income. The challenge is that, and what I think many don't realize, and some agents, they realize, they just don't think about it, I think, is because, you know, we're so used to going through the norm, is the loan officer does not make the decision on whether or not a borrower gets a loan.
Yep.
Right. So, and whether they're the best loan officer or the worst in the country, they don't make the decision. So, you know, a long time ago, and for different reasons, it was for distressed sale reasons, because we needed to move very quickly once we had short sale approval letters. But I started doing the full loan approval back in, gosh, it was maybe like 2010. But again, back then we were doing a full underwritten loan approval. So in other words, we are collecting all of the documents from the borrower, application, all of the income, all of the assets. We're reaching out to the employer. We're getting verifications of employment for overtime, commission, bonus pay. We're basically, you know, we're collecting all the documents. We're sending everything to the underwriter, and we're letting the underwriter make the formal decision. So the representative of the lender who is going to give the money is the one who's making the decision. And we're doing that with a very specific intention, because again, I can get on the phone with a listing agent and say, oh, my client's qualified. I mean, what do you think I'm going to say? My client's qualified. They're good to go. I can do this. I can do that. but at the end of the day, it's lip service, right? So what we want to do is we want to be able to call that listing agent and say, okay, you'll notice that the offer is submitted and there is no loan contingency within the offer. And here's the reason why. We've treated this borrower as if they're already in escrow. We've got their conditional loan approval subject to a signed purchase contract, a clean preliminary title report, and of course an appraisal. And oh, by the way, here's a copy of the approval if you'd like to go over it. Here's proof. So we're actually, showing proof with the intention of separating not only ourselves from other lenders, but ultimately the main goal and the main priority is to separate our clients from their competition, which is all the other buyers, right?
Yes.
We're not saying we're better, we're saying we're different. And different gets the seller's attention. And different is, we're not saying that this is the end all be all savior to get your offer accepted. We're simply saying, look, if it's you against 5 other buyers, we're using this strategy to get you into that second round of seller multiple counter offers. Obviously, seller and price is important, but terms are important too. And I've had many sellers accept our client's offer when they were not the highest. In fact, we had one where we had one, I won't name his name just in case for private reasons, but we had a transaction where he was not the highest. Now, granted, it helped. He had a huge down payment, but he wasn't the highest offer. And because we were able to show proof that he was fully approved and it helped that he had a huge down payment, then obviously his offer was accepted over an offer that was, I think, $30,000 to $40,000 higher than our client's offer. So, it makes a difference. And if you read a lot of our reviews, you're now seeing the clients say in the review that, the full loan approval was how they got their offer accepted on the property that they wanted. That's the key. Is we're not doing this to have someone buy a home. Our goal is to have them buy the home that they really want. And in order to do that, obviously, we're going to have to get very aggressive with, how we go about structuring their offer, and we want it to be different and stand out.
Speaking of using the correct terms for being fully approved, is underwritten approval the correct term when you say they're fully underwritten at that
Exactly.
point?
So yeah. So when I call a listing agent, I specifically tell them this borrower is not pre-approved, and I stop right there for a second and let that sink in. And I let them know that the borrower is fully underwritten and approved by the actual underwriter. And I clarify, this is not a desktop underwriter, a DU automated approval, gone through a computer system. This is beyond that. This is, again, treating it like the borrower is already in escrow on the property.
And you're going to loan docs.
Yeah, right. Once we have the, the contract and the appraisal and any inspections you guys want to do, then yes, right. I mean, the only other thing I could think of would be is if it's a condo, then clearly there's some condo due diligence that has to be done with the HOA depending on the down payment percentage of the buyer. But yes, that is correct. So, we're getting these approvals, we're looking at them, we're reading the conditions on the approval. If there is something that's needed further, then we're going and getting it before the borrower writes the offer on the property.
Yep.
Mm-hmm.
Yeah, and that's the only reason, you're phenomenal to work with, and we've done so many transactions like that, Jason. And you're touching on the key component, especially in today's market, and especially where the market's going, is that you have to you as a buyer and an agent, you have to stand out above the rest. And if you can represent your client in such a way where when you're going out showing properties, darn well the properties you're showing, you can write an offer, you can be fully approved, you can close in 21 days or less, and you're willing to waive all contingencies. And that is something that you and your company offer to agents and their clients, correct?
That is absolutely correct. And I think you see the the Rocket Mortgage and things online and Super Bowl commercials and things like that. And I think that those are still a computer generated, more of an automated underwriting system, whereas we're standing behind ours with a true full loan approval, and we're giving, and I think the biggest differentiator is we are actually giving the blessing and the go ahead to the agent, because really I believe it's our responsibility as a lender to remove the loan contingency from the start and present the offer as good as cash. We're not saying it's cash, we're saying it's as good as cash. So to put that in writing and stand behind it is something that not a lot of lenders are willing to do. I mean, there are other lenders that do a full approval, but I haven't seen a lender be as consistent with the turn times, deliver the pricing that we deliver with it, and be able to stand behind, you know, removing the loan contingency. The combination of those three,
there's not a single lender out there that can
go
do
toe
it.
to toe with anyone. I'll say on that one. So
There is not a single lender, and I stand behind it personally. So then this is a great closing for you. And I sadly don't want to do it, but I do because I think you're phenomenal. But are you open and willing to work with, are you still available to other agents that need lenders?
I am, but now I'm very particular about who we work with. So as long as they agree to execute the process the way we do it, and use the wording, use the tools, the education piece, because a big part of when we work with agents and our clients isn't just about, again, getting the transaction done. We feel that it's a process of educating the client with the goal of being more confident. And as they're more educated and more confident, then they're going to be more successful. So there's a process to that. There's a very, you know, set workflow that we use. And as long as they're open to that and they continue to use it, then yes, it's not for everyone.
Well, and also I think a good point is it takes a lot of time to go through this process of getting new clients fully approved. This is not something that you're just doing for everybody that comes knocking on your door looking for an approval, right? This is for people that you have relationships built up with, that you trust, and that trust your process as well. So, I mean, we understand in working with you that this is not a quick, you know, 1 hour underwritten approval. You're going through the motions to do all the steps that need to be done to get them to the point of approving them fully.
Right. Typically, the turn time takes 24 to 48 hours, depending on, you know, a W-2 borrower salary. We can get that done in 24 hours. If you're self-employed, it's probably going to take 48. If you're jumbo self-employed, it might take 72 on a jumbo loan with a self-employed borrower. So it will depend on the scenario. But on the W-2, you know, Fannie Mae loans, I mean, we'll usually, and when I say those turn times, that's from the time we have all of the documents, not the first document, right? So by the time we have all the documents from the borrower. So, but yeah, you know, it's a relationship. Definitely most of the agents that I work with, I've worked with for a long time. We've been doing this for a long time. It just happens to be playing right into the market and the limited inventory.
Well, thank you, Jason. Thanks for your insight. It's been great just having you part of these Q&As over the last few months, that we've been able to help educate the people that follow us and that we reach out to on social media. So thank you for your time. And
yeah, it's been amazing, Jason. I just think I hold you on the highest pedestal. And I think you're the most amazing lender I've ever worked with. And you're so professional, and it just blows me away. So just in closing, can you give everyone your information just in case those do need a rock star lender like yourself?
Yeah, you can find me a few different ways. If you just Google Jason Gill mortgage, or the Gill Group mortgage, I think there's a couple of Gill groups in Texas that do real estate or appraisals, but that would be one way. Or you can, our website is SoCalPurchaseLoans.com, and my phone number is 858-401-3332, and all of my information is online on Zillow or Yelp or Google Business. So try to, not hard to find me.
We'll post it as well.
Yeah.
Okay.
We're gonna definitely post this out for you as well. Not that we want to, because we don't want to share you, but we will. But anyway, thank you so much, Jason. I really appreciate your time, and all the best to you and your family. And thank you. I really appreciate it, and apologize it went a little bit over, but
that's all right.
And okay, well, thank you, Michelle. Yeah. You guys have a great Thursday, and tomorrow's Friday. So enjoy your weekend, everyone.
Thanks, Jason.
Bye, Jason.
Bye.